Hello, welcome to the Dreamers Podcast. I'm your host, Anne-Lyse Wealth, and I'm really excited to get into today's episode about how to manage your money during a recession. Are we in a recession? Are we not? People keep going back and forth. I personally believe that we are, but here's how a recession is defined. It is a significant decline in economic activity that is spread across the economy and lasts more than a few months. If people want to continue to debate about whether we're in a recession or not, it's up to them. I would like to operate under the assumption that we are. And if you're listening to this podcast or watching the show, you have probably been through a couple of recessions in the past. One of the most recent recession that lasted for a good amount of time, but that marked people, millennials, is the Great Recession, right? In 2007, 2008. And today in 2023, what can we do? How can we prepare? How can we manage our finances during these times so that we can come out of this recession on top? Number one, reassess your expenses and increase your savings rate. I'm sure it's challenging, right? Because we've seen prices go up. But what I've seen in the news that has really been scary is that some people are actually going into debt in order to adjust to the new prices. When what we should be thinking about or doing is looking at the money that we're spending currently and what it is that we can cut. It is a good thing to do during challenging financial times, right? So look at your expenses. Is there anything that you spend your money on that you can really do without right now? Or can you benefit from having a little extra money in your pocket every month? Those are some of the questions that we should all be asking ourselves so that we can identify those things that we can remove from our budget that wouldn't necessarily impact the amount of joy that we have. Definitely someone who talks about interest-based spending, and I try to maximize my joy with the expenses that I make. Let's keep that in mind. Let's be financially responsible, but also let's take a close look at the expenses that we have. That's the first part. Then increase how much you save. As you're lowering your expenses, you should save more. That is a challenge, I understand, because prices are going up, but it's definitely worth a try. And just one pro tip to think about is maybe consider adding another source of income outside of your job. It will help you also be more comfortable, be prepared in case something were to happen at work. So whether you decide to pick up a side hustle or even a part-time job, sell used items, the objective is to do that so that you can save more money and beef up your emergency fund. This will be key in the event that there's a reduction of workforce at your job or you lose your primary income stream. It'll provide some sort of cushion. Number two, what we want to do is invest in things that increase in value over time, right? We always talk about assets versus liabilities. An asset is something that you acquire that is supposed to increase in value over time. Properties, which is real estate, stock markets are the first ones that come to mind. You want to make sure, though, as you invest, that you have a long-term outlook. Don't invest money that you think you might need this year, 3 years from now, even 5 years from now. When you are dealing with a recession, you want to really think long-term. I would say even go as far as 10 years. If this is money that you can afford to forget about for 10 years, then yes, go ahead and make the investment. Also, when it comes to the stock market, we've seen tech companies take a big hit, but we've seen if you were invested in a total stock market index fund, you wouldn't have taken as big of a hit. So this is actually a good time to look into putting your money in the stock market, but also putting your money in basically don't put all of your money into one stock. Don't put all of your money into one industry. Make sure that you diversify. Make sure that you have a long-term, safer investment like a low-cost index fund that will allow you to invest in the total stock market. But then if there are certain companies that you're looking at currently that are on sale, because there's a lot of companies on sale, I'm not giving you any financial advice, but like the Microsoft, Apple's, Google, Amazon, they all have been taking a beat in recent weeks. Now might be a good time to buy, but again, don't dump all of your money. Continue to invest on a dollar cost average base, a little bit at a time. Also, when it comes to real estate, right, interest rates are unfortunately up right now, but that also means that there's less competition if you want to purchase a property. If you can do your math and find a property that makes sense, that will be cash flowing, so that will bring you money every month, but it also provide an opportunity to build wealth through your equity in the company growing, the value of the property growing, which will also help grow the equity that you have as you pay down the debt, if you take on debt for this purchase, right? I remember this quote from real estate investor Atia Blair. Atia said in an article that I wrote from the Harvard Business Review Ascend, she said, I was 23 in 2007 when I bought my first rental property. I lived in it, I rented it out after moving out. I kept the property throughout the recession, because once you sell it, you don't get the wealth building part of real estate. So during a recession, buying rental real estate properties will provide additional cash flow for you, and also an opportunity to build wealth through property appreciation over the long term. This is not the time when we start selling our assets. This is not the time when we look at our stock market portfolio or real estate and think, oh man, it's going down, I need to get out. No, this is the time to hold on to it. If you can, add more to it, because millionaires, billionaires, wealth is created during recession. So you should just hold on tight and invest more. Remember that investing is a long-term plan, is a long-term play. So don't think about the short term, think about long term and how this investment can help you on your wealth building journey. 3, diversify your investment. I said that earlier. Don't just dump everything in one stock, one industry. The more diversified you are, the safer you're going to be, because more than likely things are not going to go bad all at once in all of the areas. It's usually progressive. Diversifying helps you manage some of that risk. And when it comes to diversification, I spoke with Mark Russell, who is a former financial advisor for this piece in HBR Ascend, and he talks about index funds. Index funds provide what most investors want in their portfolio. It provides diversification, passive management, because if your portfolio is actively managed, that will increase the fees that you will pay on your returns. If it's passively managed, low-cost index fund, the expense ratio or the fee that you pay are just simply significantly lower. Here's a tip here. In the long run, the stock market and real estate assets increase in value over time. Keyword, in the long run. The sooner you start investing, the better you will position yourself to build long-term wealth. But don't forget to diversify. Number 4, leverage tax advantages. I cannot say this enough. Sometimes, if you don't have a tax strategy, you might end up spending money on taxes that you could have saved and you could have invested and built wealth for the future. There's a multitude of tax advantages available to you when you invest in assets. For ages, for decades, for hundreds of years, people have been using the stock market and real estate to build wealth for that reason, because there are tax advantages to invest in the stock market. There are tax advantages to invest in real estate. For instance, some retirement accounts like 401k, 403b, 457, with those accounts, your contributions are deducted from your income to calculate how much you should pay in taxes. If you decide that you're going to go with a traditional 401k, traditional 403b, 457, your contributions up to the limit for that year that is set by the IRS is going to be deducted from the income that you have that's taxable. So what does that mean? That means you pay less in taxes, and then that money that you would have paid otherwise in taxes, you actually use it to invest it. Another option is to go with the Roth option. What's going to happen with that is that the money is going to grow tax-free until retirement, because you already paid your taxes up front. The beauty of that is that that money then is going to continue to grow, and you're only going to pay taxes when you retire. The other option is the Roth option. The Roth option basically says that I'm paying my taxes up front. I'm paying my taxes right now, so that in the future, this money that I would have invested, that I would have accumulated returns, I'm not owing any more taxes on it. And a good strategy usually is to do a mix of both. Or depending on where you are in terms of retirement, how close retirement is, and do you think that you're going to make more money in retirement or less? That's how you decide if you should go harder with the Roth account or the traditional accounts. But for me, I'm in my 30s. I like to do a mix of both. Believe it or not, Taxes are our biggest expense. There are many, many ways to legally save money on taxes, and we have to take advantage of them. Otherwise, we are literally living hundreds of thousands of dollars, and sometimes that even turns out to be millions of dollars on the table. Why would you pay taxes on something when you could literally take that money, invest it, and make more money and pay taxes later, or pay taxes now and not have to pay taxes later? Having a tax strategy is key. So use tax advantage accounts and tax deductions that will help you reduce your overall tax liability. I actually did an episode when it comes to real estate and the tax strategies that you can also apply to save money on taxes with real estate. The episode with real estate investor Atia Blair, I can't think of the episode number, but that talks about 1031 exchange and other ways that you can save money on taxes through real estate investing. Let's recap. Number 1, reassess your expenses and increase your saving. Number 2, invest in things that appreciate in value over time. Number 3, diversify your investments. And number 4, leverage tax advantages as much as you can. I hope you like this episode. And if you do, I suggest that you go back and listen to episode 99, How to Make the Best of a Recession. If you like this episode, stay tuned and watch the one right after it, episode 99, on how to make the best of a recession. That's it for today. I hope you enjoyed today's episode. I cannot wait to see you back here next week for another episode of the Dreamers Podcast. Bye.